Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Okay, good afternoon and welcome to today's Savant Live webinar. We're very happy that you've taken time out of your busy schedule to be with us here today. My name is Jack Phelps, and I'm a financial advisor and the managing partner of our Savant Boston office, which is located just west of the city in the town of Wellesley. For over 36 years now, I've had the privilege of helping some really terrific individuals and couples both prepare for and navigate their complex retirement transition. And I'm as excited today as I've been at any time in my career because of all the tools and the resources that we now have at our disposal to be able to help you. So today we're going to discuss key milestones on your path to retirement. These milestones play a critical role in your retirement strategy. So what we've done is we've proposed and planned these milestones in the form of a timeline for you to sort of use as a checklist to be able to help you avoid the most common mistakes that we see so often, and at the same time take advantage of potential opportunities when they become available to you. And ultimately help you make smart, educated decisions at every important inflection point so that you can increase your odds of having a great outcome and ultimately experiencing the ideal future that you've worked so hard for. So if you've been a dedicated saver and you've been very conscientious with your money over the years, I strongly recommend investing time to watch this entire webinar. We welcome your questions. If you have any questions throughout the presentation, you can submit those at the toolbar, which is at the bottom of our screen here. And I promise to cover each and every one of those given the time that we have available to us today. Okay, so why don't we get started? Let's start talking about our 8 key milestones. I'm going to share my screen with you now. And as you can see here, there are 8 of them, and they range in age from age 50 all the way through down to age 73. And we're going to deep dive into each and every one of them. So why don't we jump right into the first one, which is catch-up contributions, which happens for you when you're age 50. And for those of you who may have not saved quite as much as you wanted to up until now, and that a lot of us have that feeling if we've been paying for kids' educations and we've been putting our kids through school and taking care of everything, if you haven't done as great of a job, you have more incentive now to start contributing more money to your retirement plans. So up until the age of 50, you can contribute $23,500 to your 401k plan or your 403b or your 457. However, once you reach age 50, you can increase that amount by $7,500 per year up to $31,000 per year. And then new in 2025, for those of you who are between the ages of 60 and 63, and how they came up with that limit, I have no idea. But if you're between 60 and 63, now you can increase and put $11,250 more for a total of just shy of $35,000 per year pre-tax into your retirement plans if you wish to do that. And of course, you have the Roth option as well. If you also contribute to an IRA, the limits have been raised there as well. Once you reach age 50, instead of being able to put just $7,000 a year, you now can contribute up to $8,000 a year. So a really good opportunity. If you haven't done as good a job with your saving, the first milestone that you hit is age 50. You've got some catch up to do. Okay, let's jump over to our second milestone, and this happens for you when you reach the age of 55, and it's something called the Rule of 55. So what is this Rule of 55? Well, the situation happens when you are looking to retire, or if you have a temporary gap in your income from work and you need to supply yourself with income and you would like to withdraw money from your company's retirement plan. The challenge you run into is the way the IRS has set it up is that they allow you to contribute to your retirement plan. However, if you go to touch your money prior to the age of 59 and a half, you have to pay a 10% penalty in order to get access to your money, in addition to the taxes that you have to pay. However, with the Rule of 55, what that says is that you can access money and take a withdrawal from your company's retirement plan who you just separated from, and you can do that once you reach the age of 55, and there's no 10% penalty to do that. Really good opportunity. So again, just to be clear there, when you're 59 and a half, you're going to be able to take money out without the 10% penalty, but the window between 55 and 59 and a half, you're sort of stuck. And what this gives you the opportunity to do is to tap into your plan that you currently work for. Just to make a distinction there, however, though, this only applies to the employer who you are currently with. So if you have changed jobs over the year and you have multiple employer-sponsored plans out there, 401ks, 403bs, this rule only applies to your most recent plan that you separated from. And the other factor that you want to take into consideration is you want to take a look at your employer's summary plan description, because not every single plan allows this. So take a look at your employer's summary plan description to make sure that they allow this. But it does allow you a really nice opportunity. Okay. So when it comes time to take money out of your plans, if you are thinking about retiring prior to the age of 59 and a half, you want to give some real thought to where you can grab your money, because you don't want to end up paying penalties. If you've done such a nice job saving your money, the last thing you want to do is pay taxes, but even worse, you certainly don't want to pay penalties. So if you're under the age of 50, 55, and you're going to be retiring, and yes, we do see folks doing that these days, where you want to go to access money at that time is a taxable non-IRA brokerage account. So a brokerage account that you may have, CDs, money in the bank, things of that nature. Once you hit 55, between 55 and 59 and a half, then you can tap into your most recent employer's plan without any 10% penalty. And then once you hit 59 and a half, as we'll talk about in just a moment, then you have full access to your company's retirement plan or your traditional IRAs with no 10% penalty. Okay, let's switch gears now over to the next milestone, which is at age 59 and a half. And as I alluded to just a moment ago, this is when you can start to take some penalty-free withdrawals. And again, just to reiterate, once you reach age 59 and a half, the IRS says, okay, now you've deferred it long enough. You can access your funds. There's no penalty to do so. We want to incentivize you to start drawing money, as we'll talk about a little bit later when we get into your required minimum distributions. Another opportunity that presents itself is if you're still working and a very large percentage of your retirement savings is built up in your employer's retirement plan, your 403b, your 401k, things of that nature. If a large percentage of what you've saved over the years is in there, but the investment options that are within your plan are not exactly optimal for where you are in your life right now. They may very well have been just fine when you were 30 years old, when you're 40, maybe even when you're 50 years old. However, when you're approaching your retirement transition, your allocation is going to change, and so your investment needs change. So if you don't have the best options, one of the great opportunities you have once you hit age 59 and a half is you can exercise what is known as an in-service withdrawal and roll all or part of your balances from your existing plan over to your own IRA. Once it's in your own IRA, then you can invest into anything you wish. You've opened up the ceiling in terms of where you can invest and allocate to fit your target needs. So just to be clear here, a couple of things to get clear. Number one is you're still working for this employer. And if you're still working for the employer, we're not suggesting that you stop contributing. We want you to still contribute to the plan, take advantage of the match, take advantage of the tax deferral. However, the balances that are in your plan are not locked in place once you're 59 and a half. You can take those and roll those over to your own individual IRA and allocate those any way you see fit. And then you remove the constraints of the funds that are offered inside of your 401k plan. Again, like with the rule of 55, however, though, you want to be checking with your plan's summary plan description because not every single employer allows this. We've seen this over the years. More and more are offering it, but not every single one does. So you want to clarify that for yourself. Okay, now let's jump over to what I refer to as the big one, which is age 62. And 62, there are a lot of things happening. One of them, of course, is your ability to be able to take Social Security. But the biggest thing that we see happening when people reach age 62 is they reach the point in their lives which we refer to as the paycheck dependency threshold. And so what exactly is that? So the paycheck dependency threshold happens to most folks after they've been working for 30, 40, maybe even 50 years. When you sort of pause and you reflect and you start to wonder, seriously, can I afford to stop working if I choose to and still live the lifestyle that I want to live? How much can I afford to spend? How do I manage my affairs? If you start asking yourself those questions, then you have reached what we call the paycheck dependency threshold. And there are two problems that we see with folks that I've seen over the years, over the last 36 years, with folks who reach this stage in their life. The first one is too many folks are working longer than they need to because they feel as though they have to, even though they may not have to. And what this comes down to is a lack of planning on their part. They haven't taken the time to really figure out and determine, can I really afford to do so? After finding out if you can afford to stop working, you may very well choose to continue. I'm in that boat. I love to work and I have no desire whatsoever to stop. However, knowing that I can and knowing that you can is very powerful and it changes your life. So we're going to talk about how you're going to find that out in just a moment. The second situation happens is the flip side of that. And the flip side is that you retire, but you sort of pull your punches and you spend less than you can afford to out of fear that you're going to run out of money someday. And that's completely understandable. If you think about it, you've been working and saving for 20, 30, 40 years, earning a paycheck, contributing to your retirement plans, and now you're going to stop on a dime. You're not going to get that paycheck anymore. You're no longer contributing money to your plans, and now you're going to start to withdraw money. That situation invokes fear in just about everybody. And what happens is, in that case, is folks pull back and they end up missing out on the ideal future that they could be experiencing with proper planning. So neither of these two situations are situations that you want to find yourself in. So we recommend finding out your answers, spending some significant time finding out your answers to three very, very important questions. And I recommend spending some time with this. So the first question that you want to answer is, over and above what I'm going to receive from Social Security, from a pension or pensions, if we happen to qualify for pensions, and then rental property, if we have any rental property, over and above those three amounts, how much do we need to withdraw from our retirement bucket of investments in order to support our ideal lifestyle? And the answer for that, of course, is very different for everybody. We find over the years that the range of lifestyles change completely. It's very important for you to take the time to do that. You want to determine not only how much you need, but when you're going to need it. And once you figure that out, then the next question that you have to answer is, what's the long-term investment rate of return that you need to earn on your investments in order to generate the inflation fighting returns that you need to earn in order to generate the cash flow necessary for you to live the lifestyle that you want to live? So if you think about that a little bit, let's just use an example. We have two couples. We have, say, couple A and couple B. However, let's say that they both have the same amount of money saved. They both have, just for round numbers, $2 million saved up in their retirement bucket of investments, their IRAs, their 401ks, their CDs, their brokerage accounts. They each have that amount. They're each the same age. They each have the same amount of Social Security income coming in, and they each have the same pension. If we look at that from afar, we might say, gee, these two individuals are exactly the same. Their investment needs are the same. They actually could be quite different. Because if couple A determines that the amount of money they need to withdraw from their retirement bucket over and above Social Security and a pension is, let's say, $80,000 per year, that's one scenario. If couple B then goes through their numbers and they determine that they need $120,000 a year, those are two completely different scenarios. If the goal is for both of them to outlive their money, right? If their goal is to be able to do that and to be able to have their money last for as long as they do, if couple B is going to withdraw $120,000 per year and couple A only needs to withdraw $80,000 a year, in order to have their money last, couple B has to earn a much greater rate of return. So this is why it's so critically important to determine, over all these 36 years I've been doing this, I've yet to meet one person who knew the rate of return that they absolutely needed to earn on their investments in order to make their money last. It's a critically important money for you to understand. And then the second part of that is it also gives you a target with which you can use to direct your investments. Most folks have an investment plan and they don't have a target. This provides you a target, which then leads to the next. So let's assume that you've done this homework. You've determined how much you need to withdraw from your retirement bucket. You've determined the rate of return that you need to earn. Now the big question is, of course, what's the investment system that you should implement in order to potentially earn the inflation fighting returns that you need to earn? I can't overemphasize enough how important I believe it is for you to spend some serious time with these three questions in order to increase your confidence that you can afford to retire when you want to retire. Okay, so now let's talk about the other big considerations when you're 62 years old. And those are the two biggies: Social Security and health insurance. Health insurance is a big deal because prior to reaching age 65, when Medicare kicks in, you have to cover all of your health insurance needs. So we're going to talk about that in a moment. Before we do that, though, let's jump into Social Security and talk about that. And Social Security is an interesting topic, and you'll hear a lot of information out there. And the dominant thought is that everybody should just wait until they're 70 years old to collect the maximum benefit. And that may very well be the best option for you. However, over all these years, we think that's short-sighted because we think there's a lot of issues that go into choosing what's the best option for you. Should you choose it at 62? Should you choose to collect it at your full retirement age? For most of you on the call here is either age 66 or 67, or should you wait until age 70? So there are 8 factors I recommend considering. So let's quickly go through those, and I think you should give some serious thought to this. The first one, which we find most people don't give a whole lot of thought to, is your health and your life expectancy. And this sounds obviously once we start talking about it, but if you think about it, if you feel very strongly that you're going to live a very long life, you have a long history in your family of living, of longevity, your health is really good, versus somebody who says, no, I don't feel very confident about that. I've had triple bypass before, or my family does not have longevity, that's going to influence should you take Social Security sooner rather than later. If you don't believe you have long life expectancy, that's going to lean toward you taking your Social Security a little bit earlier versus deferring. The second thing you have to give some serious thought to is your level of investment assets. And that's both money that's inside of IRAs and outside of IRAs. The more money that you have in your investment assets in relation to Social Security, the less dependent you are on Social Security. And so that's going to have an influence on when you should start taking that as well. Another biggie, which we don't find enough folks giving enough time to, is spending versus preserving your assets. So think about this. If you are 62 and you are no longer going to work, and we're going to talk about the rules around that, but let's assume that you're 62, you're no longer going to work, you have a choice at that time. You can either start to receive your benefits right then at 62, you can wait until you're 67, or you can wait until you're age 70. And so what would make you do that? The thing to remember is that if you forego and you say, no, I'm going to wait until age 70, what most folks forget is then they have to make up whatever Social Security would have paid them at 62 by withdrawing money from their investments. So just round numbers, let's assume that if you start taking your benefits at 62, then you're going to receive $2,500 per month, $30,000 per year. If you forego that and say, no, I'm going to wait until I'm 70 years old to begin collecting my benefits, what you're doing essentially is you're telling Social Security, hey, wait, you keep my money for now. I'm going to spend my money right now. I'll collect a higher benefit later. It's worth it. I've done the math. It's worth it to wait. If you do a little bit of math there for a moment, that's $2,500 a month, $30,000 a year for 8 years. That's $240,000 that you're telling them, no, wait, keep it. And that doesn't take into account the cost of living raise that you're going to receive each year on your Social Security. It also doesn't take into account the potential earnings on that money that you withdrew in order to wait until you're age 70. So again, you have to give that some serious thought, because remember, Social Security benefits are not inherited by your kids. Social Security is for you and it's for your spouse. Once both of you have passed away, Social Security does not continue to the kids. So if you have spent down your assets in the interim, your kids and your family are not going to inherit that money. The next issue is something that was not talked about very much, and all of a sudden now it's in the news a lot, and that is the viability of Social Security right now. It's no mystery that the Social Security Trust Fund is in trouble, and by all estimates, between 2034 and 2035, they recommend that there's going to be a 27% cut in benefits unless they make some changes. So the question you have to think about is, am I taking political risk by delaying my benefits? In other words, how strongly do you feel that they're going to be able to solve the problem, and how will they solve the problem? One way that they can solve the problem is to reduce benefits for those who are already accepting them. However, if I'm a politician, that's the last thing I'm going to do, because it's so politically unpopular, you're never going to get voted in again. So I think it's pretty certain that you'll never see anybody get a reduction in their benefits. Another option that they have at their disposal, which you've seen them do over the years, because when I first started in this business in 1989, the full retirement age was 65. It's now been pushed out to age 67. It's highly likely that they will be pushing that retirement age out yet again. So that's another thing that they have at their disposal. Another thing that they have at their disposal is something called means testing. And although they haven't done this necessarily with Social Security, except for the fact that they've started taxing it back in the early 1990s, with Medicare, as we'll discuss in just a little bit, the amount of money you pay for Schedule B for your Medicare is predicated based on the amount of income that you earn. So there are some folks paying $185 a month and others paying more than $600 a month for the exact same benefits. And the difference between the two is the amount of income that they earn outside of their Social Security. So that's an option that they have within Social Security. Either they can means test your benefits, or they could means test the cost of living benefit that you have on your benefits when you go to collect them. So I think you really need to be evaluating those political risks. Another issue is the cost of living adjustment. As I alluded to earlier, once you begin receiving benefits, you get a cost of living raise each year from Social Security. There are some years, of course, where it didn't happen when COVID struck, but on average, you're going to get a benefit every year. This past year in 2025, everybody got a 2.5% raise. Take that and compound that over time, that ends up being very significant. That has to weigh on your decision making. Another big issue is spousal benefits, right? And so the way spousal benefits works, and this is most important for spouses who either didn't work or had an interruption in their working career and thus didn't contribute the full amount to Social Security. If that's the case, let's assume, for example, that you worked, but your spouse never worked a day in his or her life. If that's true, you're entitled to get whatever your benefit is. And let's say you start taking them at your full retirement age. And let's say that's age 67, and let's say it's $3,000 per month. If your spouse never worked a day in his or her life, your spouse is entitled to receive $1,500 per month on the day that you start taking your benefit, for a combined benefit of $4,500. So the reason why this is so important is the longer you work, the higher the spousal benefit is going to be in addition to your benefit. That's a case for delaying taking your benefits. That also ties over to survivor benefits. The way Social Security works is, if that same couple was receiving $3,000 a month and the spouse was receiving $1,500 per month, when one of the two spouses passes away, the survivor keeps the higher amount, the smaller amount falls off. So for those who are collecting that higher amount, the longer you wait to collect benefits, the higher your benefits are going to be, the higher your survivor benefit is going to be. If you don't have as many other assets outside of your Social Security, that's going to impact your decision. And then finally, there's an earnings test before you collect your benefits at your full retirement age. Full retirement age, as you're going to find out in just a moment, is typically 66 or 67. If you're going to take benefits before that age, Social Security imposes a limit on the amount of income that you can earn outside of your Social Security. And this only applies to earned income. It doesn't apply to unearned. So earned is through employment, business, things like that. Unearned income comes from interest in the bank, dividends you may earn, capital gains, things like that. So this only applies to earned income. So if you're between the ages of 62 and your full retirement age, they allow you to earn $23,400 per year and still collect your full Social Security benefits. However, the more money you earn over and above that limit, they start to pull some benefits back. So let's just make the assumption that you earn $35,400, which is $12,000 above the limit. They're going to pull $2 for every $2 above the limit that you earn. They're going to pull $1 back. So if you earn $12,000 above in this example, they would pull back $6,000 in that calendar year. So again, that's going to weigh your decision on when you should start taking as well. If you're going to still work part-time, if you have other earned income coming into your life. But again, this is on a spouse-by-spouse basis. If your spouse is working full-time and you're not at all, that doesn't matter. You can still collect based on your employment. Now let's hop over to health insurance. So health insurance becomes a very big deal because before the age of 65, if you are working, your employer may very well offer a plan, and the typical plan covers as much as 78% on average of typical employees in this country. So let's say that you've stopped working and you're not 65 yet. You don't qualify for Medicare. So there's this stopgap. And this is something that we see stopping people in their tracks in terms of their desire to want to retire. A lot of folks come to us and say, gee, I don't think we can afford to work. I don't think we can afford to retire because we can't afford health insurance. And as much as I agree that that is a big issue, once you do the numbers and run them forward, we have found so many folks come to us and say, gee, I didn't realize it wasn't as big a deal. Everybody makes it out to be such a big deal. So what we recommend is just using it as a line item for your expenses in order to calculate out how much you're going to need and can you afford to retire. Don't just listen to the crowd out there. have an individual plan designed to be able to answer those questions for you. So if you're looking to get health insurance before you're age 65, one place to do that is from the employer you just severed from, you retired from, because they offer COBRA. COBRA covers you for 18 months typically, and that's the first place you want to go. Second place you can go is if your spouse is still working, then you can jump on your spouse's health plan. Good idea. Another option that became available about 10 years ago was the ACA Health Insurance Exchange. Really nice option. If you do that, the amount of premium that you pay for that plan is based on the amount of income that you show on your 1040 in the year that you're collecting benefits. So this is where some strategic planning comes into place. If you do some Roth conversions or realize a large capital gain, that's going to jack up your income. It's also going to increase the amount of premiums you're going to pay for your insurance. So that's where some careful planning is necessary. If you work for a union, then you can jump on the union's healthcare plan because they have healthcare plans for retirees as well. If you have a part-time job, lots of employers offer part-time help, and they offer full benefits for health insurance, or at least 50% while you're still employed with them. Another option you have to consider. The final option you have, which is one of my personal favorites, is a health savings account. If you have had a high deductible insurance plan that you've been in for all these years and you've been contributing to an HSA plan and you've built up your health savings account, you can use the balances inside of that plan to be able to pay for your healthcare costs. So let's take a look at what those costs look like. If you were going to be on COBRA, the average cost for COBRA right now is between $400 and $700 per month per person. Just as a reference point, once you come off of COBRA, if you have to go to the private marketplace and get your own insurance, those who are in their 50s, the average cost right now is about $655 per month. Once you reach age 60, the average jumps up to just shy of $1,000 per month. So the key issue here is that while you were working, in many cases, the employer picked up a large percentage of the tab. Employees across the country right now, on average, only pay 22% of their total benefits. But once you retire and you're no longer employed, it's possible that you may have to cover 100%. Some significant planning is necessary at that time. Okay, so let's then jump into the next milestone, which plays off of what we were just talking about here, and that is at age 65, then you're qualifying for Medicare. So you're eligible to collect at 65, and if you're not working, you would then enroll 3 months prior all the way through 3 months following your birthday. If you're not working, if you are working and you stop working at a later date, you have what's called a qualifying event. A qualifying event is when you separate service and you are no longer part of an employer's plan, or if your spouse separates from service and you are on your spouse's plan. If that was true, you then have an enrollment period, a special enrollment period, to jump onto Medicare at that time. The key at that point is you then want to be picking up a supplemental health insurance plan, sometimes called a Medigap plan. In the state of Massachusetts, Blue Cross Blue Shield is the dominant player, but there are dozens of plans around. And if you think about it, Medicare covers 80% of your medical costs. Something has to be there to fill up the other 20%, and that's where the supplemental insurance kicks in. And that supplemental insurance can take care of health, can take care of prescriptions as well. Biggest issue you want to pay attention to with respect to Medicare, I touched on a little bit earlier, but there's a hidden tax waiting for you if you're not paying attention. And the way Medicare works is the Part B premium that you pay is based on the amount of income that shows up on your income tax return from 2 years prior. So if you are retiring in the calendar year of 2025, the amount of premium that you pay is based on your 1040 tax return from 2023. And as you can see here, there are some folks who pay only $185 per month for their Part B premiums, while others might pay as high as $628 per month. And in addition to that, they've got to pay $85 for their Part D. Big difference. So where this comes into play is if you worked and you stopped working and you retired in December of 2 years ago, your income was likely higher. So be ready in that first year of retirement, or the first year or two, your Part B premium is going to be significantly higher. Don't get surprised by that. However, in situations where you have some leeway on the month in which you're going to retire, or when you're going to receive income from your employer from a deferred compensation, or if you're going to do any Roth conversions, you have to give some significant thought to what you're doing over here in those areas, because that's going to heavily influence the amount of premium that you're going to pay with your Medicare Part B. So you want to be maximizing your efforts to reduce your income taxes and your Part B premiums as well at the same time. Okay, let's jump to the next milestone, and that occurs for you when you're either age 66 or 67. And the reason why it's 2 different years is because it's all predicated based on the year in which you turn 66. So for those who were born between the age of 1943 and 1959, your full retirement age, where you maximize your Social Security benefits, is your age 66. For those of us who were born after 1960, your age is is age 67. So just to give you an example of what we were talking about a little bit earlier, and it's highly likely that if you're on this call, that your numbers are significantly higher than this, but just to make it easy to understand, if you waited to get your full benefits at 66, your benefits might be $1,000 per month. Had you taken them earlier at age 62, as we talked about earlier, they might be $750 per month. And again, you have to weigh that. If you wait until you're 70, benefits could be as high as $1,320 per month. This is why planning and looking at those 8 key issues that we talked about earlier are so important in your own situation. Once you do go to claim benefits, as we talked about earlier, once you're between the ages of 62 and your full retirement age of either 66 or 67, there's an earnings test. And as I mentioned, $23,400 is the amount that you can earn and still collect your full benefits. So if you're going to earn more than that, you want to be thinking about delaying collecting your benefits. Your Social Security benefits are potentially taxable. So let's talk about that for a minute. So your Social Security benefits in and of themselves are not subject to income tax if that's the only income that you have in your life. However, the more other income that you have in your life from either employment or from capital gains, dividends, withdrawals from your IRA, withdrawals from an annuity, rental income, whatever that means, whatever that may be, the higher your other income is, the more of your Social Security that is subject to income tax. So not only is the income out here subject to tax, it makes more of your Social Security subject to tax, and as much as 85% could be taxable. If it is taxable to you, you can have Social Security withhold taxes for you if you want, ranging anywhere from 7% all the way up to 22%. It's a nice, easy way to get it taken care of so you're not surprised once you reach April 15th in the following year. With regard to Medicare, if you wait until you're 65 to collect Social Security and also claim Medicare, they can be done and you can file for both simultaneously. They can also be done separately. If you begin your Social Security at 62, you can begin your Medicare at 65 and sign up at a different time. Once you do sign up for Social Security, by the way, and you're collecting full Medicare, your Medicare premiums are deducted from your Social Security, so you're not having to write a check. It makes it a lot easier. Okay, let's talk about the next one. And the next milestone for you is when you reach age 70 and a half. And you may recall in years past that the IRS makes you take money from your IRA. It used to be they used to force you to take what's known as a required minimum distribution when you reach age 70 and a half. That age has now been moved out to age 72 and now age 73. And there are some of you who are on this call that you're going to be able to wait until you're 75 to take a mandatory distribution. What they didn't change, however, though, is your ability to make charitable distributions from your IRA directly when you're 70 and a half. And this is a big opportunity, and let's talk about that for just a moment. The challenge that a lot of folks have is when they go to make a donation to their charity, in order to deduct that, it has to be above your standard deduction. You have to itemize your deductions in order to do that. Now that the standard deduction is so high, $30,000 for most folks. Once you reach age 65, it's over $33,000. Most folks are not able to get a tax break and get a tax benefit from donating to a charity. However, once you reach age 70 and a half, if you have an IRA and you're 70 and a half and you're going to make a gift under $100,000, so anywhere from $0 to $100,000, you have the ability to make a donation to your favorite charity or charities directly from your IRA. And when you do that, that comes off of your taxable income. So just for an example, let's say that your required distribution is $50,000 a year that the IRS makes you take from your plan. If that's true for you, then you're going to get taxed on that full $50,000. However, if you make a $5,000 donation directly from your IRA directly to the charity, you don't pay taxes on $50,000, you pay it only on $45,000. So there's a lot of strategy that goes into place. It also guarantees that you're going to get a tax benefit from charitable donations. You don't have to worry about itemized deductions anymore. The other strategic byproduct of this is that by lowering your taxable income, you might also be lowering your IRMAA premiums for Medicare, as we just talked about a moment ago. Big planning opportunity. Okay, the final age at which, and the final milestone at which you can take advantage of is when you're either age 73 or you're 75. And this is when required minimum distributions come into play. So if you think about it, the IRS said, hey, we're going to give you an incentive to save. You can go all the way through 59 and a half. We're going to allow you to put money in, get a deduction for it, allow everything to grow free of tax. Once you're 59 and a half, then you can start to withdraw money, pay taxes on that without a 10% penalty. However, once you reach age 73, or for some of you on the call here, age 75, and we'll make that distinction in just a moment, the IRS says, hey, we want our tax money now. So you have to begin taking money out. So let's talk about that. And then there are some other issues with respect to the Secure Act 2.0 that you want to be paying attention to that are new. So once you reach age 73, for most of the folks on the call here today, you have to begin taking a distribution from your IRA, your 401k, and your 403b, and it's all based on your life expectancy. For those of you who turned 74 in 2032, that age has actually bumped out to age 75. Nice opportunity. If you don't take your required distribution, here's the good news and the bad news. The good news is, in the old days, the amount that you didn't take out, that would be subject to a 50% penalty. So for going back to our example, if the amount that you needed to take out was $50,000 in the old days, if you didn't take it out, they would hit you with a 50% penalty in addition to the taxes that you owe on that. So that would cost you $25,000 plus the income taxes. Big mistake. They've reduced that down to 25%. So now it's only 25%, but that's still 25% too much. So you want to be putting this on your calendar and make sure you don't miss your required distribution. The opportunity for you that you want to be giving some thought to is, if you are younger than the age of 73 right now and your taxable income is not very high, however, when you reach your required minimum distribution age, they're going to make you take out more than you want, thus making you take it out at a higher tax bracket, maybe 24 or 32%. Take a look at the opportunity to be able to convert some of your traditional IRAs over to a Roth IRA now during your years where you don't have as much taxable income. You may be able to pull money out of your traditional IRAs, move them to a Roth IRA, pay a lower tax bracket, 10%, maybe 12%, maybe even 22% might be beneficial for you. And then once the money is over into your Roth IRA, then that money is then tax-free for the rest of your life. Big planning opportunity. The other issue that you want to be aware of is that there's been a big rule change with respect to inherited IRAs, meaning when your family inherits your IRA, what exactly happens? So spouses, and only spouses, can withdraw money from their deceased spouse's IRA, move it over to their IRA with no tax consequences whatsoever, unlimited amount. Non-spouses, however, though, your children, your grandchildren, nieces, nephews, whoever is not a spouse, does not. There's another set of rules for them. In the old days, they would be able to take that, move the money over to an inherited IRA in their names, and then have a mandatory withdrawal over the rest of their lifetime. If they're only 40 years old, their life expectancy is 45 or so years. That means they can stretch their withdrawals and the tax burden over 45 years. That has all changed. Now, they have to take that money out, and the money has to be removed by the end of the 10th year following your passing. So if you passed away in 2025, your IRA has to be completely empty by the end of 2035. This is where planning and using Roth IRAs in your planning can be so helpful, because if you move money over to a Roth IRA prior to your required minimum distribution age, what you've done is you've taken money out at a lower tax bracket that you've paid and moved it over to a Roth IRA, and from there forward, it's then tax-free for not only your life, but also for your kids' lives. Big planning opportunity. Okay, so as I mentioned earlier, these milestones play a critical role in your retirement strategy. And so what we've done here and what we recommend for you is using this timeline as sort of a checklist, if you will, to be able to help you avoid those common mistakes that we see way too often. And at the same time, take advantage of opportunities that we just talked about at the same time. And really what we want for you is to be able to help you make educated, smart decisions with your money at every important inflection point so that you can increase the odds of you getting a really great outcome and essentially living the ideal future that you work so darn hard for. So the issue that we find with so many folks that I've witnessed so many times over the last 36 years is that folks make decisions about their investments over here, and then maybe about their Social Security over here, and then maybe their tax decisions over here. And essentially what they're doing is they're making those decisions in a vacuum. And that's a big mistake. If you want to have the maximum impact and effectiveness, those decisions should all be made simultaneously using very careful and strategic planning to be able to maximize your benefits in all three at the same time. Critical area. So as you think about that, there are three questions I'm going to ask you to leave with and think about today. And one of them is, are you taking advantage of the strategies that we've already outlined here today? Some you may have already done, some you may not have done. So then the question is, what opportunities are you now going to prioritize? And then would you benefit from a second opinion from an experienced financial advisor? And if the thought of a second opinion is intriguing to you, then we welcome you to schedule a free 15-minute introductory call to discuss and assess your retirement strategy. And you can take care of that. There's a button that's on the toolbar that's right below you. If you want to take advantage of that, simply click that and we'll find a convenient time to be able to answer your questions and have a good, strong conversation. Okay, so now let's hop over, if we will, to our questions. And we do have quite a few here. So let me just pull those up. I could probably stop sharing my screen. And I'm going to try to get to as many as I can here. The first one has to do with Social Security. And the question is, I thought waiting to collect my Social Security benefits at 70 was best. Can you expand more on what you said about spending my investments? Okay, let's talk about that a little bit more, because I think this is an often overlooked topic. So where it comes into play is if you're under the age of 70 and you're contemplating when to start taking your Social Security benefits, you can either start taking them right away, and maybe let's say that's at age 62, and let's say your benefit was going to be $2,500 per month. And but if you wait to get them at age 70, they might be, let's say, $3,800 per month. It sounds obvious, so I'm just going to wait and collect them at age 70, because 3,800 is so much more than 2,500, and that is the dominant thought that we hear out there. What you have to remember, though, is if you make that choice, what you're telling Social Security is, hey, I don't want my Social Security benefits. I'm going to wait 8 years and I'm going to spend my own money. So what I mean by spending your investments is if you're not getting $2,500 a month that you could have gotten and you're going to delay that, that $2,500 a month has to come from someplace for you to live on. And that's $30,000 a year. If you run that then over that 8 years, you're talking about $240,000 that you told Social Security to keep. And not only that, they also keep the cost of living raises that you would have gotten had you started at 62, and the investment gains, the potential investment gains from keeping the money there as well and not spending that as well. So yeah, again, you have to give some serious thought to that, because not only are you spending the money and thus you're spending down your own assets for yourself, but also for your family. Because keep in mind, Social Security benefits are not for your family. They're for you and for your spouse. Once you pass away, those go away. So if you have spent your money down over those 8 years, that means there's no money to go to your family. If you don't have kids and you're not worried about the beneficiary arrangements, this is not an issue. However, you have to give some serious consideration to it. Okay, next question is, this one has to do with inherited IRAs that we were just talking about. Can you clarify the new 10-year requirement? Because I believe that there is a new rule. Yes, there is. So let's talk about that again just for a moment. When this has to do with non-spouse beneficiaries, so not moving from your deceased spouse's IRA over to your IRA, this is when both of you have passed away and your money is inherited by your family, by your kids, your grandkids, your nieces and nephews. Spousal rules are different than non-spouse. So non-spouse beneficiaries used to be able to take money and stretch the distributions, your withdrawals from there, the requirement over their lifetime. Now they have to have your IRA emptied out within 10 years. And the rule change that has changed, and this is and I'm glad the participant brought this up, is that if you have already begun taking money from your required distribution, if you're already subject to a required distribution right now and you pass away, your beneficiaries have to continue at a bare minimum that required minimum distribution over that 10 years. However, at the end of the 10 years, all the money within your IRA has to be completely removed. Big distinction. So again, a lot of planning goes in here. This is where the Roth conversion situation comes into play, which is really beneficial. The more money you can move out of taxable IRAs during your lifetime, not only is that a good situation for you for lowering your tax benefit, for lowering your tax rates on the amount you take out, it's also good for your family because they can potentially inherit your money at a lower tax rate as well. Okay, let's look at another one here now. You mentioned 3 important questions that we need to answer. One of those was the investment rate of return that we need to earn. Can you explain what you mean by that? Yeah. Again, this is one of those that most folks, I have found, again, 36 years of doing this, I have yet to meet anybody who knew the answer to this question. So the first of the 3 questions I talked about there was getting crystal clear on the amount of money that you need to draw from your investments. And the way you calculate that is figure out what life costs for your ideal, how much of that is going to be covered from your Social Security benefits, how much is covered from your pension, and how much is covered from any rental property if you have any. The amount over and above that amount is the amount you need to draw from your investments each year. Critically important to know that number, but once you know that number, then you can calculate what the rate of return is that you need to earn in order to make your money last. So going back to our example, if both couples are the same age, they both have the same amount of money in their retirement bucket, IRAs, 401ks, brokerage accounts, CDs, things of that nature. If they both have the same amount, let's just say it's $2,000. However, couple A needs to withdraw $80,000 per year from their $2 million. Couple B needs to withdraw $120,000 per year from their $2 million retirement bucket. Couple B must, if they both want to have their money last until they're 90 years old, couple B has to earn a much better rate of return. So that's why it's critically important to determine the rate of return, number one, for your confidence, because you want to be confident that you can afford to retire. But more importantly, or equally important, is that you then have a targeted rate of return that you must earn, and you have a barometer with which you can evaluate your investments to determine if you're on track or not. If your specific question was not answered, I'm going to ask you to enter that into the chat bar right now. When this webinar is over, then you're going to be sent a survey. If I can ask you simply to put your question in there, and I promise that we will get back to you to be able to answer that. But with that said, I want to thank you for taking time out of your busy schedule to be here with us today. We've enjoyed doing this. I thoroughly enjoyed doing this. I hope you benefited from it. If at any time that you're looking for more information about us at Savant, we'd like you to visit savantwealth.com. That's www.savantwealth.com. While you're there, you can also take advantage of that free introductory 15-minute discussion to talk about your retirement strategy. And so with that, I thank you, and I wish you a great day, and I look forward to being with you again soon. Thank you.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.